Hi, this is Hutch, and I can't wait to show you our brand new banking calculator. What the banking calculator does is help us simulate these case studies like you've seen from us in the past, but people are wondering if banking's still a valid option in this post-coronavirus environment. Interest rates have gone down, dividends have gone down, the stock market's going crazy. Carriers have revamped all their pricing for products, and so people are wondering if banking with insurance is still a good option. And I would say now more than ever, especially with all this madness going on, it's actually better than ever. But don't take my word for it. Let's take a look at the math behind this claim. And what the math is going to show you is the mathematical equivalent of this conversation that I know you've seen before in my other videos. If not, you can check out bankingtruths.com/basics to watch the full 6-minute video to understand the concept of how the banking concept works before looking at all these details. But long story short, what our claim is that paying cash for everything doesn't get you anywhere. And you can't ever really gain any ground by pouring money into accounts that pay little or no interest. And once you spend the money, you certainly can't earn any interest. However, by running the same funds through a properly structured banking policy, even if you borrow against it, when you pay down those loans, you actually end up at a higher place in line each and every time because your assets are continuously compounding in the policy. You're not taking money out, it's never leaving, it's in there growing for you. So let's take a look at the math behind that right now. All right, so this is specifically going to be a banking case study using IUL, Index Universal Life. If you're looking for whole life and you don't want anything to do with IUL, I understand that's a different video. Go here instead. But it may be worth looking at just to see the difference between this and whole life. So this particular gentleman's 41 years old. He's preferred. He's putting in $150,000 a year. He's doing quite well. He's capped out on how much he can put into his Roth, and so he wants to put it in something like Index Universal Life, where he can get market participation and still be exempt from future higher taxes. You can see at the end of 5 years, no further premiums are going in. He's taking a $660,000 loan against his policy. In year 6, there's still $100,000 of cash left in there. And you can see in year 5, he's already ahead of the curve. Even year 4, he's almost break even in spite of having $4.75 million of death benefit over and above his cash value. But I digress. After taking the $660,000 loan, he's going to pay back just the $660,000 in this analysis, just to compare apples to apples with paying cash. Now, he could and he should pay back loan interest. However, people, when they buy things with cash and save up cash, they generally don't pay themselves back with interest. So this is supposed to be an apples to apples comparison. After 6 years, you can see he's going to take out another $660,000, or borrow against his policy rather, take it out of his bank account if he'd never met us and doesn't have this. But he's going to borrow $660,000 and he's going to pay back $660,000 1/10 at a time. Now you can see in the third loan cycle in year 18, he's taking a much bigger loan amount, $1,020,000, and he's going to pay back just the $1,020,000. That's $170,000 times 6. If you do the math, that's $1,020,000. And at the end of 5 years, he's going to come out with $1.7 million of net surrender value. Now you can see there's $2.4 million of cash value in their earning index crediting, but he only has access to $1.7 million. Why? Because he still has accruing loan interest because he never paid any of the interest. All he did was just pay the principal. So that interest keeps accruing on itself. And you can see after the completion of the whole loan cycles, you can see that interest building upon itself. Now, just so you know, this is a compliant AG 49 illustration. And we are showing this particular carrier has a locked loan rate of 5%. Now, when we do this on the loan money, even though we're showing 6.06% crediting on unloaned money, we're only allowed to show 1% higher crediting on the loan money. Now, some of you may be thinking, well, that's too much. Don't worry, we're going to show you a little bit later. It's actually not that crazy. So, this whole illustration that you just looked at, that's basically our green line. The green line going up with the red loans underneath it, that's represented by this illustration. Now let's look at the blue line. So if we go down here and pull up the banking calculator, you're going to see the same cash flows going in. And by the way, this is the blue line we're looking at. So this is not the illustration. We're just taking the same cash flows and we're going to replicate some kind of savings account, bond fund, whatever they're using. You could even do stocks, but we're trying to do something with a similar risk profile as Index Universal Life. So as it says they're paying with cash options in blue, same cash flows, 150,000 5 times, no more premiums going in. Instead of a loan, a withdrawal against the account of $660,000, paying back 110 6 times, another 660 withdraw, paying back 660 over time, the $1,020,000. Now notice this is very interesting. The account actually goes negative by $190,000. Now, obviously, no bank is going to let you do that. Maybe you can get a note from your mother and she'll do that. But what I want you to see is that just by banking with IUL, you may end up having a lot more capacity. Because if we actually go back to the illustration, what we'll find is that in year 18, there's still an additional 138,000 of cash value. So what that means is, in addition to being 190,000 ahead of the game, or 190,000 short with the blue line, you actually have an additional 100 and something thousand still in your policy that you didn't borrow against. So you actually end up with more capacity in the future. You may take a hit in the early years, but not much, especially with this policy. We're using a high early cash value rider. But I digress. Even still, assuming you can get a free loan from your mother and you pay back the 170 over 6 years, at the end of all of this, you can see the blue figure down below, what you end up with in your savings account, earning 2%, which is quite high in today's day and age. And this gentleman was in a higher tax bracket, but assuming he was only paying 33 in state and federal taxes, that's $873,000. Now, I will say too, we show a term cost of $2,000 only for 7 years, because for 7 years, he has exactly $4.75 million over and above his cash value. Now, he is in his working years, and this is important, and he does have additional death benefit over and above his cash value the rest of the time. We're not baking that in, but we did want to price the cheapest term policy for that amount at preferred right here. And so this makes it a fair comparison. Well, how much does he have using the policy loan? That's in the green box over here. You can see 1.7 million. That's a lot of extra cash. How much extra cash? Well, let's show you using the banking calculator. So what we can see is he has 94% more cash, or $827,000 more dollars, simply by banking with IUL. Now, he also has $480,000 of additional death benefit. The cash will continue to converge upon that. After 25 years or so, you don't necessarily want to end up with a lot of death benefit if cash value is your goal, because the two are competing against each other, if you will. If you want more death benefit, there's going to be more cost of insurance. But for my clients that are looking for maximum cash value, what we did do is we dropped the death benefit as soon as we could to the minimum possible amount after the 7th year. Now, some of you may be thinking, well, wait a second, 2%, that's not very much. Well, what does it take then, if we scroll back here, what does it take? What if we earn 5%? Well, we're still not even close, almost not even 1.2. What if we earn 9%? Okay, 9% we're way ahead of the game. What about 8%? 8% we're not. Even with that 9%, if we throw the 9% up there for a while, even if we put the tax bracket he was supposed to be in, using state and federal taxes, that brings even the 9% way below where we're at with the IUL. Now, I know some of you were like, Hutch, 6.06, that's pretty optimistic. So we're going to look at the last 65 years of the S&P 500, since that's what this is based on. And we're just going to look at that in a vacuum, not the rolling averages of 25-year periods. And even at the last 65 years, all by itself linearly, it's 6.01%. But what's interesting is, even with the 9.75% cap, if we go through the rolling periods, you can see the blue line, which is the raw market index, is actually behind most of the time, even with the very conservative cap. Now, it does start to pull ahead, and especially when we get to the rip-roaring 90s, it starts to pull dramatically ahead. But this is a unique situation because this is when major companies started moving away from defined contribution plan, or excuse me, defined benefit plans to defined contributions or 401ks. So when you have all of a sudden the retail public that couldn't buy 100 share lots of stock before, and now they can buy micro shares, when tons of people are buying stocks, what happens to the stock market? It goes crazy. So obviously the cap hurts it there. But if we look at the next 20 years, what's interesting is that whole 20-year period from 2000 to 2019, if we isolate that, the 9.75% cap is well ahead. Now you can see even during that time with a lot of volatility over the last decade and the first decade they call the lost decade, we're still averaging 5.64%. Now keep in mind you can also earn higher crediting, but let's just examine a 5% scenario. So in addition to a 5% locked loan, there's also another type of loan for this IUL, which says you can be in any index crediting strategy, especially the one I'm going to tell you about later on that's uncapped, and you can have a variable loan rate. And right now it's at 3.25%. Now it will vary with interest rates, but what we're going to do to be fair here is we're going to lower the IUL crediting by 1%, but we're not going to lower the variable loan rate because we're going to call this an outside loan because we're actually not allowed to do illustrations, showing policy loans without the crediting being one more. But there's plenty of banks that will do premium finance and you can get rates around this, sometimes even lower. So we're going to pretend this is an outside loan from a bank at 3.25%. And if we scroll down and we look at what we end up with, the 1461 and 1.914 of death benefit, what we're going to find is that it's not quite as good as before, but we are ending up with more cash value. It's 67% more cash value than had we paid cash. And I know some of you are thinking, well, even though there's a 0% floor, there are some charges. That's true. There are charges. So what you're seeing here with a completely different calculator we made is something that helps you analyze charges. And in the red line are the actual charges with the dollar amount year by year throughout the life of the policy. What's happening in green is this shows the charges as a percentage of account value because this is how people measure, say, their AUM fees, assets under management, with their money manager. Usually they're used to paying around 1% to the manager plus the mutual fund fees. And if we look over to the right, we can see the fees start out high as a percentage, but then they drop to something very reasonable. And we can actually go down here and the alleged hidden fees of IUL aren't really hidden at all. In fact, we made this to unpack and unbundle them so you can see exactly what they are, see how they total up, and see how they stack up as a percentage of your account value. And this particular illustration was run at 4%, not 6.06, not 5, at 4%, where you're potentially paying the most amount of charges because the cash value is not growing up against the death benefit quick enough. And so what you can see is after the 5th year, when you're done paying, it becomes almost like hedge fund management in the 2% range. But after year 11 or 10, now we're down to like index funds, not index universal life, but index funds, index mutual funds. And if we scroll down here, we can see we're averaging for the life of the policy about 1.1%. And this is a very conservative illustration. Everything we've shown you here has been extremely conservative. And that's what you need, is a team who will help you model things conservatively to see if something like this is going to be right for your hard-earned dollars. You need a team who can help you understand how the sausage is made, who can help you see subtle distinctions that maybe you wouldn't have caught on your own when looking at illustrations. You need a team who can help educate you on the different companies, the different crediting strategies, the different riders out there, and not just the latest, greatest, bright, shiny object, to help you understand how these companies treat their in-force block of business, their old policyholders. Our team is standing by right now to help you do that. Simply go to this link below, put your information in, and we can help you understand and decide whether or not this is going to be right for a long-term piece of your financial puzzle for your family for the next several generations.